Western Digital just delivered strong numbers and the market punished it anyway. After the company reported its latest results, shares dropped sharply in after-hours trading, falling more than 9% in one session. That reaction is not a sign that the business suddenly collapsed. It is a sign that investors expected something extraordinary. Western Digital has become one of the market's biggest AI infrastructure trades. Its stock had already more than tripled this year on the belief that artificial intelligence would create an insatiable demand for storage. Now the question is no longer whether AI needs more data. The question is whether WDC can keep exceeding expectations that are already moving at full speed. To understand the story, start with what Western Digital actually sells. Unlike companies building AI chips, WDC is primarily a hard disk drive manufacturer. Its drives sit inside massive data centers operated by cloud companies and hyperscalers. These facilities store the information that AI systems use for training, search, recommendations, and inference. Every new model creates more data. Every user interaction creates more data. And that data has to live somewhere. Western Digital separated its flash memory business into SanDisk in 2025, leaving the company focused on hard drives. That made WDC a cleaner bet on large-scale, high-capacity storage. It is less glamorous than a graphics processor. But behind every powerful AI system is a mountain of files, and mountains require space. The latest report showed why the bulls became so confident. Western Digital's fiscal fourth quarter revenue rose 44% year-over-year to roughly $3.75 billion, beating expectations near $3.69 billion. Adjusted profit also came in above the consensus estimate. Management then projected first quarter revenue around $4.1 billion, plus or minus $100 million. Adjusted earnings guidance landed near $4 per share, also above Wall Street's forecast. On paper, that is exactly the kind of report investors usually reward. Demand remains strong in data centers. Capacity is valuable. Pricing has improved. And the company appears to be benefiting from a market where supply cannot instantly expand to meet the AI build-out. But markets do not trade on yesterday's numbers. They trade on the gap between reality and expectation. Western Digital had already become a huge winner before this report arrived. Its shares had more than tripled during the year, as investors priced in years of AI-related demand. That created a dangerous setup. A company can beat estimates and still disappoint if its forecast is not strong enough to justify the price. In this case, the guidance was technically above expectations. But it did not feel far enough above them. For investors crowded into the same trade, good was no longer good enough. The market was waiting for a blowout. Instead, it received a solid forecast and treated solid as a warning. There is another layer to the reaction. WDC's data center business is powerful, but it is not the entire company. Western Digital still operates in markets connected to personal computers, consumer electronics, and other non-cloud customers. Those areas can weaken when memory prices rise and consumers delay replacing devices. That creates an unusual split. The strongest part of the business is tied to the AI boom. The smaller parts can still be dragged down by an ordinary economic slowdown. This is why the headline numbers require context. Data center demand may be accelerating, while consumer demand is quietly losing momentum. Investors are now watching to see whether AI growth is large enough to overpower those weaker segments. The next question is durability. AI companies are spending enormous amounts on infrastructure, but spending cycles do not move in a straight line. Cloud providers can accelerate orders one quarter and pause the next. Customers may negotiate harder once supply improves. Higher prices can lift margins today, then attract competition tomorrow. Western Digital also carries the risks of a hardware business, manufacturing costs, product transitions, customer concentration, and debt. The company has been working to streamline its balance sheet, including plans to sell part of its SanDisk stake to reduce debt. That could improve financial flexibility. But it also reminds investors that this is not a pure software growth story. WDC still has to build, ship, and finance physical products. So what should investors watch from here? First, listen for evidence that hyperscale customers are committing to longer-term capacity plans. Second, track pricing. The AI storage thesis depends on demand staying ahead of supply, not merely on more units being shipped. Third, watch margins and free cash flow. Revenue growth matters, but the quality of that growth matters more. And finally, watch the stock's reaction to future beats. If WDC keeps reporting strong results and the shares continue falling, the market may be signaling that valuation, not operations, is the central problem. The company could be executing well while the stock remains vulnerable. Those are two different judgments, and confusing them is how investors get trapped in a winning business at the wrong price. The WDC story is not simply bullish or bearish. It is a test of how much AI optimism the market can absorb. Western Digital is positioned inside a real infrastructure bottleneck. Artificial intelligence needs storage, and high-capacity hard drives remain essential to the data center economy. The latest earnings report confirmed that demand is strong. The sell-off confirmed that expectations are even stronger. For now, the central risk is not that the AI story disappears overnight. It is that the story remains true, while the stock has already priced in too much of the future. That is the line investors must watch. Strong business, expensive expectations, and a market that has become increasingly difficult to impress.